Welcome back to our trading course. Today, we're going to dive deeper into the essential concepts of trading, including bid, ask, spread, liquidity, volume, and slippage. These 6 ideas will help you navigate the markets with confidence and make better trading decisions. Let's start with the bid and the ask. Think of the bid as the price a buyer is willing to pay for an asset, and the ask as the price a seller wants to receive for that same asset. Imagine you're at a farmer's market, and you want to buy some fresh produce. The seller quotes you a price, and you negotiate until you agree on a price. In trading, the bid and the ask work similarly. However, in a highly liquid market, there's often only a small difference between the two prices, known as the spread. The spread is the difference between the ask and the bid. It's a crucial aspect of trading, as it directly affects your costs. Let's say the bid for a stock is 50, and the ask is 50.2. The spread is 0.2, or 2 cents per share. When you buy or sell a stock, you pay the ask price, and when you sell or buy, you receive the bid price. The spread is a built-in cost, and it varies depending on the instrument, market conditions, and the liquidity of the market. But, as a beginner, you might make a common mistake underestimating the impact of the spread. Here's an example to illustrate this. Imagine you want to buy 100 shares of a stock with a current price of 50. The ask price is 50.2, and the bid price is 49.9. You have a trading account with a balance of 500. If you place a market order to buy 100 shares, you'll likely pay the ask price of 50.2, resulting in a total cost of 502. However, if you place a limit order at 50, you may receive a better price. Now, let's talk about liquidity. Liquidity refers to how easily you can buy or sell an asset without significantly affecting its price. Imagine you're at the farmer's market again, but this time, there are only a few sellers, and they're willing to charge a higher price. This market is illiquid, and you may struggle to find a buyer or seller at the desired price. In contrast, a highly liquid market has many buyers and sellers, allowing you to trade quickly and efficiently. Volume, or the number of shares traded, is a measure of market activity. A high volume indicates a more liquid market, where you can easily buy or sell an asset without affecting its price. However, it's essential to note that volume alone doesn't guarantee liquidity. For example, let's say a stock has a high volume of 100,000 shares traded per day, but most of those trades are executed at the same price. This might indicate that the market is still relatively illiquid. Slippage occurs when the price you expect to pay or receive isn't the actual price at which the trade executes. Think of it like trying to get a taxi at rush hour. You order the taxi, but when it arrives, it's more expensive than what you agreed on. This is similar to slippage in trading. As you learned these concepts, you might have noticed how they are interconnected. A high volume doesn't necessarily translate to a low spread, and a low spread doesn't guarantee a liquid market. Understanding these relationships is crucial for making informed trading decisions. Now, it's time for a practical homework exercise. Open a demo trading account or a paper trading journal, and observe the bid and ask prices of a few assets. Note the spread, and analyze how it affects your potential losses or gains. Next, look at the volume and liquidity of the same assets, and relate them to the bid and ask prices. For example, let's say you're looking at a stock with a current price of 50. The bid price is 49.9, and the ask price is 50.2. The spread is 0.3, or 3 cents per share. If you place a market order to buy 100 shares, you'll likely pay the ask price of 50.2. However, if the volume is high, you might be able to negotiate a better price. Another common mistake beginners make is confusing high volume with liquidity. Let's say a stock has a high volume of 100,000 shares traded per day, but most of those trades are executed at the same price. This might indicate that the market is still relatively illiquid. To relate volume to liquidity, ask yourself these questions. By answering these questions, you can get